All right, today we're going to try and make sense of Oracle's latest earnings report. And let me tell you, it's a real head scratcher. On the surface, it looked like a huge win, but then the stock just cratered. The real story, as we're about to see, is buried deep in the numbers. So, this is the big question, right? The central mystery. Oracle drops its numbers on December 10th, and they look good, better than expected even. But the stock, it just nosedived. So what gives? How does good news turn so bad so fast? And here it is, laid out plain as day. You've got this headline number, $2.26 per share, that just absolutely crushed Wall Street's expectations. But then you look at the stock price, and it's in a complete freefall after hours. That disconnect, right there, that's our clue. It tells us the headline is hiding something. Okay, so let's unpack this whole contradiction. To really get what's going on, you have to look at both sides of the story. And we're going to start with the good news, the really, really good news, actually, the part that has the entire AI world buzzing. So let's talk about this AI order boom, because the demand Oracle is seeing right now, it's not just big. It's almost hard to wrap your head around. We're talking about the biggest names in tech lining up basically with blank checks to get access to Oracle's cloud. Look at that number, $523 billion. What is that? Well, in corporate speak, it's their remaining performance obligations, or RPO. In plain English, it's the gigantic mountain of future business they've already locked in. This isn't just some big corporate number. To put it in perspective, $523 billion is bigger than the entire economy of a lot of countries. It's a signal of absolutely insane demand from the biggest players in AI. Think OpenAI, think Meta, all of them desperate for what Oracle has, which is the specialized infrastructure you need to train these monster AI models. So, if they have a backlog of over $500 billion, why on earth did the stock crash? Well, this is where we have to peel back the layers. Because under all that good news, the company's actual financials, they're telling a very, very different story. Okay, here's the first big piece of the puzzle. You see that amazing $2.26 earnings number? Well, it turns out it wasn't all from their actual business. A huge chunk of it, 76 cents to be exact, was from a one-time thing. They sold off their shares in a chip company called Ampere Computing for a cool $2.7 billion gain. Right, so you take away that one-time sale, and suddenly their real core earnings were only $1.50. And that number, it actually missed what Wall Street was expecting. So the big headline beat was really just some financial engineering. It had nothing to do with the health of the business. And believe it or not, that wasn't even the scariest part. This was the number that sent a shockwave through the market. Negative $10 billion. That's how much cash they burned through in just one quarter. It's just a staggering amount of money to lose. People talk about free cash flow a lot, but it's pretty simple. It's the lifeblood of a company. It's the actual cash you have left after you've paid for everything, your operations, your new equipment, all of it. So a negative $10 billion number, it means Oracle spent way more money building data centers and buying gear than it made from every single one of its customers. So this isn't just some accident or a miscalculation. This massive cash burn is a choice. It's part of an incredibly high-stakes gamble. Basically, Oracle is betting the entire farm on one thing: winning the race to build the world's best AI infrastructure. So what's their secret weapon in this fight? It's something called RDMA. Now, without getting too technical, it's a super fast networking technology. It lets all the computers, all the GPUs in their data centers, talk to each other directly without bogging down the main processor. And for training these massive AI models, that speed is everything. It's the key advantage they believe they have over rivals like Amazon and Google. And this quote from Larry Ellison really says it all. When they talk about chip neutrality, it perfectly explains their pivot. See, selling that Ampere chip stake, that wasn't just about grabbing some cash. It was about them saying, we're done trying to make our own chips. The new game is about one thing and one thing only: getting your hands on as many NVIDIA GPUs as you can and deploying them faster than anyone else. But, and this is a huge but, going all in like this comes with a terrifying price tag. All this spending is putting a massive strain on the company's financials. And you know who's noticing? The credit markets, the very people they need to borrow money from, and they are getting very, very nervous. It's really like a chain reaction, a cascade of risk. You can see it right here. First, they make these massive investments in AI. That leads to burning way more cash than they're making. So what do they have to do? They have to take on a mountain of new debt. And that, of course, makes their credit health look worse and worse, which in turn makes the risk of them defaulting spike. It's a classic domino effect. And man, the warning signs are flashing bright red. We're talking about total debt heading towards $150 billion. The big credit agencies, Moody's and S&P, have both put them on a negative outlook. But maybe the most telling sign is this last one. The cost for big investors to buy insurance against an Oracle default has shot up to levels we haven't seen since the depths of the 2009 financial crisis. That is not a good sign. So, where does that leave us? Buy or beware? On the one hand, you've got this unbelievable order book. On the other, you have a balance sheet that's screaming danger. So how are we supposed to think about Oracle's future? You know, a great way to see the picture is to put Oracle side by side with its peers. And when you do, the story just jumps off the page. Look at that cloud growth. It's absolutely phenomenal, blowing everyone else away. But then you look at free cash flow and debt. They're the only one burning through cash like this, and the only one whose credit rating is getting worse, not better. And really, this is what it all boils down to. This is the whole debate in a nutshell. The bulls, the optimists, they look at that $523 billion order book and they say, see, they've already won. They are the AI infrastructure play. But the bears, the skeptics, they look at the debt and the cash burn and they say, there's no way they survive long enough to actually deliver on all those orders. I think this quote from our own report really sums it up perfectly. The old Oracle, that stable, boring, dividend-paying software company, it's gone. It just doesn't exist anymore. What's left is something totally different. It's a highly leveraged, high-risk, high-reward bet on AI. It's basically a call option on Larry Ellison's grand vision for the future. And that leads us to the final critical question. Is Oracle an AI titan just waiting to be born? Or is it a giant that's about to collapse under the weight of its own debt? The truth is, the answer really depends on one thing. Can they survive this brutal, incredibly expensive financial winter long enough to see their promised AI summer arrive?